Hello everyone, and welcome to another video of this course. In this lesson, we will be treating asset retirement obligation, also known as ARO. And under this topic, we'll be looking at the following subtopics: what ARO is and how it is estimated, recognition and measurement, journal entries and updates. And under that, we'll be looking at creating, approving, posting, and editing journal entries and updates. So what is asset retirement obligation? In accounting, an asset retirement obligation describes a legal obligation associated with the retirement of a tangible, long-lived asset, where a company will be responsible for removing equipment or cleaning up hazardous materials at some future date. Asset retirement obligations should be included in a company's financial statement to present a more accurate and holistic snapshot of the enterprise's overall value. Asset retirement obligation accounting often applies to companies that create physical infrastructure which must be dismantled before a land lease expires, such as an underground fuel storage tank at a gas station. AROs, asset retirement obligations, also apply to the removal of hazardous elements and or waste materials from the land, such as nuclear power plant decontamination. The asset is required to be retired once the cleanup or removal activity is complete and the property is restocked back to its original condition. To calculate the expected present value of an asset retirement obligation, companies should observe the following iterative steps. They should estimate the timing and cash flows of retirement activities. They should calculate the credit adjusted risk-free rate. They should note any increase in the carrying amount of the asset retirement obligation liability as an accretion expense by multiplying the beginning liability by the credit adjusted risk-free rate for when the liability was first measured. They should note whether liability revisions are trending upward, then discount them at the current credit adjusted risk-free rate. They should note whether liability revisions are trending downward, then discount the reduction at the rate used for the initial recognition of the related liability year. Let us look at recognition and measurement. Asset retirement obligations are initially recognized at the fair value in the period in which they are incurred, and the amount of the liability can be reasonably estimated. Determining the appropriate timing of recognition may be complex if the asset retirement obligation arises over a period of time or due to changes in laws. For those asset retirement obligations arising from changes in laws or regulations, the asset retirement obligation should be initially recognized in the period the law or regulation is enacted. Once the reporting entity has determined whether a duty or responsibility exists upon retirement, it will then need to assess whether an obligating event has occurred that creates a present obligation of an entity to transfer an economic benefit. If such an obligatory event has occurred, an asset retirement obligation qualifies for recognition. Construction projects often extend beyond a single reporting period. Although construction may take time to complete, the reporting entity will usually know prior to the start of construction whether it will have a related asset retirement obligation. The method used by accountants for asset retirement obligation during construction should be based on the individual facts and circumstances. Two methods that apply are the proportionate method, and the specific method. Now let's look at the proportionate method. The asset retirement obligation is recorded proportionately as the underlying construction is completed. For example, if 50% of the cost of the construction asset has been incurred, 50% of the asset retirement obligation will be recorded. This method may be appropriate for asset retirement obligation related to an entire facility when the reporting entity is required to remove the facility upon retirement. In this case, the cost of removing the facility would be recorded in proportion to the amount constructed. And this is for the proportionate method. Now, in a specific method, an asset retirement obligation is recorded when the specific costs leading to the obligations are capitalized. For instance, absent other obligations, if the cost of an asset retirement obligation related to the nuclear power plant arises as a result of the fuel rods being installed, the asset retirement obligation will be recorded at the time the fuel rods are installed. Reporting entities involved in asset construction should develop policies for the recognition of asset retirement obligation during the construction phase. Although there are different approaches, we generally accept the same method to be applied consistently to similar assets. While reporting entities should begin accreting an asset retirement obligation immediately upon initial recognition, depreciation of related asset retirement costs should not begin until related asset is placed in service. Now let us look at the initial measurement of asset retirement obligations. Asset retirement obligations are recognized at fair value in the period in which they are occurred. And if a reasonable estimate of fair value can be made, fair value should be determined under ASC 820, the fair value measurement. In rare circumstances that a reasonable estimate of fair value cannot be determined, the liability should be recognized when a reasonable estimate can be made. A reporting entity asserting that a reasonable estimate of fair value cannot be determined should have sufficient evidence to support this conclusion, because it would not be appropriate to delay the recognition of an asset retirement obligation on the basis that management will not perform the related asset retirement activities in the foreseeable future. An important part in measuring an asset retirement obligation is the length of time of its settlement until its settlement. The asset useful life provides one data point about the potential timing of the asset retirement. However, there may be a distinction between the useful life of the asset and the dates the asset retirement obligation will be settled. All factors should be considered in developing retirement scenarios, including license expiry dates, the reporting entity's retirement history, management's plans for improvements that could extend the life of the asset, and lease terms as acceptable. Now let us look at journal entries and updates. Journal entries are posted to the ledger to record data from accounting transactions that reflect your entity's business events. Journal creation, approval, posting, and editing work together in the recording process to produce accurate financial records. So remember, there are 4 aspects: creating, editing, approving, posting, journal entries. So in creating journal entries, the process begins with creating journals. You can create journals in several ways. You can enter them manually. You can use a spreadsheet. You can import journals into the ledger. You can create automatically from formulas or processes. All methods produce a journal entry consisting of a batch that determines the accounting period of all journals associated with the batch, one or more journals with a category or currency attached to each, lines that contain the accounting for the transaction. Next is approving journal entries. If you're using journal approval, you can select the request approval action for the journal batch to initiate the approval process. After the batch is approved, you must then post it. If you skip the action of requesting approval and instead select to post the batch, or if the batch is picked up for posting through an auto post criteria set, the batch proceeds through the approval process, after which posting is automatically submitted. The next step is posting journal entries. You can post journal entries only in open accounting periods. Keep all but the current periods closed to prevent posting of amounts in incorrect periods. During the posting process, the journal entry is validated, and if successful, the credit and debit amounts are updated to their respective accounts in the ledger. Please note that you can't change the journal entry that's posted. Once posting has successfully finished, run reports and perform queries on the updated account balances in the ledger. You can configure security using post privilege to allow certain users review and post journals, but not create or modify them. And finally, we'll be looking at editing journal entries. Edit journal entries as needed before they are posted. After posting, either reverse and enter the journal again, or enter a new journal to correct the amounts in question. Thank you very much for watching this video. I will see you in the next video where we'll be learning about financial reporting and disclosure. Thank you once again, and bye for now.